Hi guys, this is Umar with you. It's been almost more than a week since I posted a video on our channel. Due to some personal issues, I was not able to post any video. Everything is getting back to normal and I also hope you are all doing good. The last few days are one of the best days for option sellers. If you are an option seller, I hope you would have made good money. The main reason for that is India VIX has come down drastically and is now almost 15% from the usual 20%. So that's a piece of good news for option sellers. But the problem in option selling is you need to have a good amount of capital to be successful, and if things go wrong you need to be super rich to make adjustment. And of course there is no guarantee that after doing all the adjustment that you will turn profitable. That's one thing you will have to remember while trading in options, and particularly in India where SEBI is doing all kind of things to get retail traders out of the market. And the recent intraday margin which we used to get from brokers are all history now. No more intraday margin. There are many traders in social media raising voice against SEBI, that is hashtag SEBI against retailers. So you can join them if you are an intraday trader. Now let's get back to the point. Now in this video we will talk about the ratio spread adjustment strategy. This is no big secret or rocket science. Everybody knows this strategy, and in fact if you have watched our videos we have mentioned this many times. Let me explain you how this works. Right now, what is ratio spread strategy? Let's see. First I will construct a ratio spread strategy, then we will see how we can manage this strategy or adjust this strategy, right? So we are in the month of June, 24th June. I am in the month of 24th June, right? Market is where now? It's around 15,600, right? Now if you buy one ratio, if you want to construct a ratio spread, what I am going to do is, since market is at 15,700, I am going to buy 15,700 strike, which is at the money, for around 192 rupees. And I am going to sell far out of the money calls, right? Since I am bullish and I expect the market to be going forward, it might be testing 16,000 or maybe 15,800 or 15,900. So what I believe, I go and sell 16,000 call, 2 lots. Yeah, I have bought 15,700 for 192 one lot, and I am selling 16,000, that is which is trading at around 70 rupees 2 lots, right? Now once I do this, this is how it is going to look, right? You don't have any problem unless until market breaches 16,248. that is our break even point, upper break even point, right? And on the downside you don't have to worry, you are protected because you have sold the calls. So if the market comes down you don't have to worry, right? Now in this scenario where I have constructed this ratio spread, where I have bought 15,700 one lot and I have sold 16,000 call 2 lots on June expiry, right? Now if you see, I will have to pay around 3,889 rupees, and the funds required is around 1.5 lakhs. Now what we can do, this is a debit transaction, that means you will have to pay it from your pocket. Now instead of selling 2 lots, if I sell 3 lots, right? Yeah, now it is going to be a credit transaction and I am going to get 1,884 rupees. Now if the market goes beyond 16,000 say 150, you are going to be in a loss, right? And if the market goes down, you don't have to worry because you will exit the trade with a minimal loss. But see, since your perspective is market is going to be the 16,000 is going to be a good resistance, you are not going to you don't expect the market to go up above 16,000. That's why you have constructed this straddle, right? This ratio spread, right? Now what if the market goes beyond 16,000? Very simple. I will tell you. If the market goes beyond 16,000, the 15,700 call which you have bought is going to be in a good profit, right? I'll tell you again. 15,700 call you have bought for 192 rupees, and 16,000 call, three lots you have sold for 170 rupees, and you have collected a net premium of around 1384. You don't have to worry if the market goes down. If the market breaches or test our break even point, which is 16,159, you are going to be in trouble. But at the same time, you have to note, when the market is going to 16,000, the 15,700 call which you have bought is going to be in a good profit, right? And the 16,000, now this 15,700 which you bought at the money is going to be deep in the money. When you bought 15,700, the delta would have been 0.5. Now when it has gone to, when the market rises and the market goes to 16,000, the delta will be how much? Maybe 0.8 or even 1 delta, right? So the 15,700 call will give you a good profit, but at the same time 16,000 will give you a loss, right? Because you have sold out of the money calls, and when the market moves from 15,700 to 16,000, it is going to be at the money, delta would have increased and you would have been in loss. But the 15,700 call will be in profit. Now what we do is, you square off the 15,700 call, book profit, whatever is the profit, and 16,000 call at the money, you turn it into a straddle. Now you have booked profit in 15,700 call, right? Your account will be in profit. You take the profit, book the profit. Then 16,000 will be in loss. I am not denying that. 16,000 will be in loss. What you can do is, you can, since you are already having a 16,000 call, you can sell 16,000 put. Once you sell a 16,000 put, same quantity 3 lots, it is going to be a straddle, right? Then you know what to do. We will manage that position later, or we will try to do another straddle if it further moves, and so on and so forth. So you don't have to worry. Now this we can do it on the both side. Now this strategy, what I have done is, I am bullish, so I have done this one. Now I can do it on the both side also. I can do it on put side also. What I can do, I can sell 15,700 put, I will buy, and simultaneously maybe 15,000, I believe 15,400 is a good support, I will go and sell 3 lots. Yeah, once this is done, you are going to take a credit of around 7,800, plus your break even point is between 15,200 to around 16,200. So in case market moves anyway, you are going to make profit. If the market moves up, the call is going to be in the money. You can square off the call and take the profit and turn that into a straddle. And put side, you don't have to worry, because you are not going to make any loss, because you have sold if the market goes up, the put out of the money put is going to give you a profit, and the call and the put also, it will be in the loss, but it will be compensated by the put which out of the money put which you have sold, right? So that side, put side, you can square off the position. Both buy and sell, you can square off the position. You are not going to be in loss, and you can book profit in at the money call which you have sold, which is in the money. Since market has moved from 15,700 to 16,000, you can book 15,000 call profit and turn that 16,000 into a straddle by selling 3 lots of 16,000 put. For this example I am saying, so it becomes a straddle. Now what if the market moves away? You know what to do. If you don't know, you can watch our channel. There are many videos I have posted on how to do things or how to manage a straddle. So that is the thing, right? Now these things we have mentioned earlier in our video also on how to manage things or how to do adjustment on straddles and strangles. And since there was many requests in our telegram channel for a ratio spread adjustment, this is one of the way to make a ratio spread adjustment. Of course there are few other ways which I will explain in the future. This is one of the best ways we can make adjustment in ratio spread. And let me tell you one thing, these things and all I am giving you confidence. You don't ask me, some people ask me show your trades, how you do this, how show your contracts, show your funds, show your back office. I have shown my back office. You can check our channel also. I have shown till 2021, year 2021, and this year also I am going to show how much we are going to make. No point in showing monthly, right? I will show in the end of the year how much we made, whether it is in profit or loss. I will show my personal account how much profit we made or how much loss we made. So this is one of the adjustment strategies which we do regularly on a regular basis. And these things are something which gives you confidence. Some people say when we post some trades in our telegram channel, sometimes I tell I have sold naked call, that, this and all, and some people reply, why you are selling naked call? If it goes and if it is tested, what you will be in loss. Even if it is in loss, we know how to manage. And these type of things, these type of adjustments are giving you confidence to do that. Whatever is the scenario, you can come out of the scenario with a minimum loss or even a good profit. No problem what the scenario is. Just try to build confidence that you get out of the trade with a profit. This type of thing is giving you confidence. I am telling you again, this type of adjustment will give you confidence, and whatever I have told in my video is also giving you confidence. That's what I am trying to do here. You are having money, no problem. You are having strategies, yeah, no problem. But you will also need to have confidence, and these kinds of adjustment will build your confidence. And in case anything goes wrong, you will be sure that you will know how to manage things and how to exit the trade with a loss. Even if you are not able to exit the trade with a profit, you may exit the trade with a minimal loss. So that's what we are trying to do here. And of course there is a disclaimer: consult your financial advisor. Things may go wrong. Even though I tell many things here, there are risk factors involved in trading in option. And I hope you enjoyed this video. Take care. Thanks for watching this video. Goodbye.